So I want to introduce you to clients of mine, Michael and Jamie, and in just 1 month, they were able to knock out $11,498 on their mortgage balance using a financial concept that I want to unpack here in this video. And you might already be assuming that it's just paying extra into the existing mortgage, making bi-weekly payments, refinancing to a lower rate, cutting expenses, or making more money, but it's actually not any of those things. And no, Michael and Jamie did not win a lottery. They're not some millionaires with piles of cash laying around. They're just average homeowners looking to pay off their mortgage faster and build up their retirement for financial future. However though, this financial concept does involve paying extra to the mortgage, but just not in the way you think. By the way, my name is Sam Kwak, one half of the Kwak brothers. I'm a certified financial education instructor, and I've been teaching finance and investments for nearly a decade now. I've been able to help thousands of homeowners, winning awards in the process, and my company is rated A+ on Better Business Bureau and excellent on Trustpilot. All that to say, I'm gonna show you a financial concept and strategy called the accelerated payoff concept that allowed Michael and Jamie to pay off their mortgage faster. But before we officially unpack this concept and the strategy, let's go and first understand the important foundation of how your mortgage interest is costing you and why it actually might be holding you back from all of your financial goals. So before we can ever have an understanding of the accelerated payoff concept, we first need to understand how a mortgage calculation works and just how much interest you're actually paying. So I have an example calculation pulled up with a home price of $400,000. Assume you make a 20% down and the remaining amount of $320,000 is financed as a mortgage over the next 30 years. Let's say the interest rate's at 6.325%, so you can see this right here. And let's say we closed on this mortgage beginning of November 2025. So right out of the gate, our monthly payment is $1,985.93. Now that's just principal and interest. So when we ultimately look at the result, by the end of the 30 years, we borrowed $320,000 initially, but after 30 years or 360 payments, we would have paid back a total of $714,935.04. So the interest alone is $394,000. I mean, you might as well have bought another house at that point. So this, 6.325% interest rate doesn't seem so innocent anymore. But the thing that you may not have known about your mortgage payment is that in the first 5 to 10 years, bulk of your payment, meaning most of your monthly payment, is going towards interest cost. In fact, if you've been paying down your mortgage for the last 5 years, do you know just how much of your loan balance you've paid down so far? Well, let's go and take a look at this example. So we started out at $320,000 for our loan balance. After making 5 years worth of payments, we're only at $298,000. We only scratched the surface. And if you notice, in the first 5 years, vast majority of our monthly payment has been going towards interest cost, and only a lesser amount has actually been going towards principal to reduce the loan balance. In fact, I actually have a real life story about this where I have an extended family. She broke down in tears in a family gathering because she worked so hard day in, day out, working at her job and making her mortgage payments for the last 2-3 years. And when she looked at her mortgage statement, she couldn't believe just how little she was paying down her mortgage. She thought she would be further along in her mortgage, but when she looked at this, and when I explained to her about this concept, well, she was shocked just about how little she was actually paying towards paying off her mortgage. But this isn't the worst part yet. What I'm showing you on the screen is something called an amortization graph. Now, this visually demonstrates how your payments are broken up and how they ultimately pay down your loan over the next 30 years. So what you're looking at is the line that goes from left to right, the x-axis, right, if I'm gonna use a math term, that represents the amount of time. So the closer you get to the right side, right, that's the 30-year mark, and all the way to the left is the beginning, the 0-year mark essentially on your mortgage. The line that goes up and down represents your monthly payment and its relationship as to how it's broken apart. Now, what really determines how much interest you're paying on a monthly basis can vary depending on the interest rate and the term length. So 30-year versus 15-year. Obviously, with the 15-year, you're actually gonna end up paying more principal in the beginning than you are paying interest compared to a 30-year mortgage. But with most typical 30-year mortgage, vast majority of your monthly payment in the first 5 to 10 years is gonna go towards interest. Now, I'm gonna draw a line around let's say about the 7-year mark, okay? And I wanna explain why the 7-year mark is really important. Well, according to the US Census Bureau data, the latest data we have, the average adult here in the United States move about 11 to 12 times in their lifetime. So if you live to be about 80 years old, roughly, and divide 80 by 11, you get about 6 to 7 years. So all things being equal, if we spread things apart, an average adult in the United States could expect to move every 6 to 7 years. So if you're a homeowner, right, moving suggests that you're selling your home, putting it on the market, buying a new home, and getting a brand new mortgage. Well, guess what happens if you get a brand new 30-year mortgage? You know, you've been making your mortgage payment for the last 7 years, and sadly, most of it has been interest payment, so you really haven't had the opportunity to pay down your mortgage that much. But you make it to the 7-year mark, you're selling your home for whatever life circumstance, buy a brand new home, get a brand new 30-year mortgage. Do you get to continue making the progress you've been making over the last 7 years? Or do you have to start all over back to the square one? Well, the answer is you have to start all the way back to square one, where, and once again, most of your monthly payment is going towards interest cost. And sadly, what ends up happening is that most homeowners repeat the cycle over and over again. So they live in their current home, pay down their mortgage a little bit, right? And then end up having to move again, sell their home, downsize. They have more kids, so they need a bigger home, or they move out of state for a different job opportunity, whatever the case might be. Many homeowners in the United States are in this perpetual cycle of being in the first 7 years of their mortgage, not really being able to pay down their mortgage and just paying interest over and over again. And this is why you may know someone in your life, or this might be you, where you've owned homes over the last 20, 30, 40 years of your life, but you never seem to be able to completely pay off your mortgage all the way to the end. And you can see why banks love the 30-year mortgage, because they know that as long as you continue to move every 6 to 7 years, and as long as they can keep you within this spot where you're just paying mostly interest costs, they have a profitable business. So even though you may have a low fixed rate mortgage right now, maybe 3% or 4%, there may come a time in the next 2-3 years where you may have to move, right? It really isn't a choice. Maybe you have to downsize, or your employer is moving, or circumstances change, right? With advent of AI, right? Things are shifting so quickly that, external circumstances may force you to have to sell your home, where your mortgage right now is at 3-4% interest rate. So with the mortgage payment and you as the homeowner perpetually being stuck in this cycle, when do you really get the opportunity to A, of course, pay off your mortgage, but B, build up your retirement, build up your investment, so that by the time you're 60, 65, or even 70, have a nest egg build up to enjoy a peaceful retirement? And because of what I'm showing you, it's getting harder and harder to be able to achieve that kind of goal. So coming back to our client that is projected to pay off their mortgage faster, you can see why there's a greater urgency or greater need to pay off our mortgage faster if we are ultimately to achieve our various different types of financial goals that we may have, right? It might be retirement, building up your investment, or whatever the case might be. So then what is this concept of accelerated payoff? How does it help us pay off the mortgage faster and take control of our finances? Again, this strategy is not paying extra into the existing mortgage, refinancing to a lower rate, which might help. It's not about, cutting back on expenses to live on a beans and rice diet, nor is it about increasing our income or taking on second jobs, which are all the ways where you could pay off your mortgage faster. But this strategy is not any of that. And many of our clients that we work with don't have a large pile of cash laying around to pay off their mortgage faster. They're not some millionaires, they didn't win a lottery. They're just average homeowners looking to pay off their mortgage faster and build a healthy retirement. So here's the ultimate background and connection to the method, the strategy, the accelerated payoff concept. Over in Australia and New Zealand, there's actually a type of a loan called an offset mortgage. Now, for my Aussies and New Zealanders, you guys know exactly what I'm talking about, and you know where I'm going with this. Now, the offset account or the offset mortgage offered in Australia and New Zealand is actually quite simple. Imagine your mortgage is attached to a savings account, and whatever money you deposit into that savings account offsets the balance on your mortgage that could be accruing interest. So let's say you have a $100,000 mortgage balance and you deposit $5,000 into the savings account that's attached to this mortgage. So what ends up happening is that the bank is going to use that $5,000 to lower the mortgage balance from 100 to 95,000, and only the 95,000 is subject to interest accrual. So what that ultimately does, it lowers the principal balance on the mortgage down to 95,000 by the $5,000 of deposit you made in the savings account. Therefore, you're now paying less interest cost on the mortgage. So just to recap, $100,000 mortgage, and you have a savings account that's attached as an offset mortgage account. You deposit $5,000 into the savings account. That essentially lowers what the bank looks at as the balance that's subject to interest calculation, therefore saving you the interest cost on the mortgage. But what's really cool about the offset account is that if you need that money out of the savings account, you can. It just decreases the offset you're making to the mortgage principal balance, which now you're paying slightly higher interest on the mortgage because you have less sitting in your savings account, offsetting the mortgage principal balance. Now, here in the United States, unfortunately, we don't have such an account. You don't have offset mortgages or offset accounts being offered by the banks here in the United States, but we do have something very close that we can use to replicate what our Australian friends are doing with the offset mortgage. Now, here in the United States, we have something called a home equity line of credit, or a HELOC as an abbreviation. With the HELOC, we can essentially replicate what our Australian friends are doing and save money and interest here in the United States. Now, you might be asking, well, why is that different than just paying extra into the mortgage and paying off your mortgage faster that way? Well, I'm gonna show you the difference between a HELOC versus a mortgage in terms of how the interest calculation is different and why that difference can help you save money and time. So here's another visual demonstration to help first understand how the interest calculation works on a mortgage. And in just one sec, I'll show you why a HELOC is different than a mortgage. So let's say we have a hypothetical mortgage at a $10,000 balance, 6% interest, and we make a one-time simple, $1,000 principal payment. And at the end of the month, we end up with a $9,000 ending balance. And therefore, the interest cost we pay is $45 on that $9,000 ending balance. Pretty simple, right? We pay down $1,000 of principal, and at the end, we pay $45 of interest costs for this given month. So you can see right away, the mortgage uses the ending monthly balance to calculate the interest. Now I'm gonna show you how it works with a home equity line of credit and why it's different. Now, right out of the bat, you can see there's a lot more things happening on the screen than there were with a mortgage. With the HELOC, it uses daily balance to calculate the interest, not the monthly balance. And here's how that works. Let's assume that we start, again, same example, $10,000 starting balance, just like the mortgage, 6% interest rate, exactly the same starting balance with the mortgage. And you'll notice right away, down here, same exact ending balance. But what goes on between the month is very different. So what the accelerated payoff strategy suggests is that instead of leaving your money in a checking account or a savings account, we're gonna take our entire paycheck and make a principal deposit into the home equity line of credit such that it lowers the daily balance and therefore lowers the daily interest cost. So let's assume that we have a $5,000 monthly income paid to us on the first and the 15th day of the month. So pretty typical for most paychecks, right? And so on the first day of the month, let's say we get a paycheck for $2,500 and we're gonna make a deposit into the HELOC balance, therefore lowering it. And the $1.23 is the interest cost that we pay for that specific day. So we go from $10,000 starting balance lowered to $7,500 line of credit balance, and the interest is calculated for that specific day. And so because we keep the balance the same, right, throughout the next couple of days, you can see the interest cost remains the same every day where the balance stays at $7,500. And the next time we get paid, our next paycheck on the 15th, we get another $2,500 that we would, again, deposit and make a principal payment to the HELOC, lowering the daily balance, subsequently also lowering the daily cost for our interest. And it stays that way all the way till when it's time to make a draw. Now, one thing that's different, completely different, with a mortgage is that the HELOC is a revolving loan, meaning that you can take the money out whenever you need to. So you can draw and borrow anytime and pay it back, borrow it again, pay it back over and over again, just like a credit card. In fact, a credit card is a form of a line of credit. So just like a credit card, a revolving loan, the HELOC allows you to borrow, pay it back, borrow again, pay it back, and the access is near instantaneous. In fact, if I were to access my HELOC right now, I just go log into my banking mobile app and specify how much I want to borrow right now. And with a click of a button, essentially I have my money moved from my HELOC over to my checking account in a matter of seconds. It's that simple and easy to access. So towards the end of the month, we're gonna make a draw of $500 to simulate paying for an expense. And we're gonna make another draw of $3,500 to, again, pay for our expenses, groceries, gas, food, you name it. And you notice that each time we make a draw, the daily interest cost goes up. Well, that's because the balance goes up, and therefore the interest cost goes up as well. So when we make that $3,500 draw, you can see a more drastic increase to our daily cost because our balance went up by $3,500. Now, you might be saying, well, Sam, this isn't very realistic. I mean, who would make a lump sum draw to pay for all their expenses, groceries, gas, food, and drinks? Well, what our clients do is that instead of making draws from the line of credit directly to pay for groceries, gas, food, etc., they instead leverage a credit card to where they can use a credit card to make all their everyday purchases, right? Gas, food, groceries, you name it. And because they're paying off their statement balance each month, they get a grace period where their purchases don't accrue interest right away. So if you're not familiar with that, when you make a purchase on your credit card, you don't typically pay interest right away until the next billing cycle. So as long as you're paying off your statement balance every single month on your credit card, the credit card company gives you roughly 28 to 30 days of a grace period where you don't owe any interest on that purchase. So what we're able to do is we're able to do all of our normal everyday, transactions and purchases on our credit card free of interest. And towards the end of the month, towards when we need to pay off the statement balance, we'll make a draw, borrowing from the HELOC to pay off our credit card completely so that we don't pay any interest costs whatsoever on the credit card, because I know the credit card interest can be very, very costly and high. And by doing that, we've essentially avoided making any draws out of the line of credit, causing the balance to not increase in the middle of the month. So we're constantly keeping that pressure of the HELOC balance down and low as much as possible, because that's how the interest cost is saved. But when it comes time to paying off our credit cards or paying any other bills like electricity, gas, utilities, right, we're able to make a draw out of the line of credit near instantaneously and pay, those obligations, pay the bills, and in the process save money and time. So by doing that process, right, by delaying any draws, taking all of your paycheck and essentially using your line of credit almost as if it's the checking account, right? So you'll notice by adding up all the daily interest costs, we get a total interest cost of $32.53 with our HELOC, even though the ending balance at the end of the month is still $9,000. So if we were to go back to the mortgage example, all right, let's go back here. Okay, same exact parameter in terms of the starting balance and the ending balance, right? $10,000 mortgage balance, 6% interest, $9,000 ending balance. And the net result is that we reduce the balance by the end of the month by $8,000. And so the same thing is happening to the HELOC. Okay, let me go back to the HELOC, but just in a different way. So the accelerated payoff strategy is doing extra payment, but with just a better tool that allows us to save more money on interest. And because we're not paying as much of interest, let's say with the mortgage, we're able to divert that extra savings into even more principal reduction on our mortgage, thus further accelerating how quickly we're able to pay off the mortgage. So between the mortgage interest cost and the HELOC interest cost doing the accelerated payoff strategy, the savings is roughly about 28%. And again, we didn't have to make more money, we didn't cut back on expenses, same cash flow, right? Same ending balance, same amount of principal reduction on our loan, the way that the interest cost is calculated is radically different, and that difference can help us save money depending on how well we use the tool. And I know from the surface, it's tempting to say that, oh, this is just borrowing from Peter to pay Paul. Well, the best example I can give you is, let's say you and I were to go outside to cut down a tree. We know to cut down a tree, we have to use a sharp object to create a fissure, right, in the tree branch, and that's how we ultimately cut down a tree. But is there a difference between using an axe versus a chainsaw? Sure there is, right? For one, it takes less calories, right? Using a chainsaw, right? You're not having to take as much swing at the tree versus with the chainsaw, it's a lot more efficient, it's less labor intensive, but at the same time, you really need to know what you're doing with the chainsaw, otherwise you could get hurt, right? So just like my chainsaw analogy, of course, we need to know what we're doing with the HELOC as well, right? It's about how we use the tool that ultimately merit a completely different result than just paying extra into the existing mortgage, and how the interest is calculated that could ultimately work in our favor to help us save money and time. So let me transition now to showing you kind of the high level overview as to how the strategy works. So we have our mortgage here, okay? All right. And let's say we have our checking account here. And traditionally and typically, you would just make payments from your checking account to your mortgage, right? So now with the strategy, the accelerated payoff strategy, we're gonna get a HELOC. All right, so there we go, a HELOC, there we go. And we're gonna borrow a portion of the HELOC, a chunk, and make a principal payment to, right, the mortgage, let's say $10,000, okay? And therefore that reduces our mortgage balance, which accelerates the amortization of the mortgage, saving us money and time on the mortgage itself. But we now have a balance of $10,000 in the HELOC, right? So what we do is, instead of leaving your money in a checking account when your paycheck hits, so here's our paycheck, instead of leaving your paycheck in a checking account, which essentially is earning you nothing, we're gonna go and take all of it and dump it into the HELOC to lower our daily balance on the home equity line of credit, okay? And we know and understand why that's important. That lowers our daily interest cost. And so once we are able to completely pay off our HELOC, we do the chunk again. So we take another $10,000 and make a principal payment on the mortgage, further accelerating the reduction on the mortgage. And then we move the money from the mortgage, which I like to say is a less efficient debt, over to a HELOC, the quote unquote chainsaw. And the HELOC allows us to pay it off faster in a more efficient manner, saving us both time and money by applying the accelerated payoff concept. So we essentially rinse and repeat the cycle where we make a chunk to the mortgage, pay off the HELOC, do another chunk, all the way till the mortgage is completely paid off. And in the process, your HELOC will also be paid off as well. And then when you need the money out for your credit card bills, groceries, gas, food, etc., you name it, you just simply make a draw back into your checking account to pay for those bills, groceries, expenses, all the things you need. And again, the access is instantaneous. It's almost like a savings account, but it kind of works backwards. Now, a common question I get all the time is, Sam, what if the bank shuts down my HELOC or the lender freezes it, therefore I can't get the money back out? And what if that happens and I'm pretty much stuck? Well, this fear and this thought, or the question, actually stems from what happened back in 2008 through 2012, right, in the Great Recession, where the banks did indeed shut down HELOCs and froze HELOCs, and it hurt a lot of people. But we have to understand what led us to that position, or what led us to that circumstance in the first place. Well, back in 2006, 2007, you might know that banks were very aggressive when it came to their lending practices. I mean, they were giving 100% loans, 120% loans. So what was happening in many cases is that banks and lenders were giving out, no job, no income, no down payment loans. But on top of that, banks were also giving out HELOCs, right, on top of no money down. So what ended up happening is that obviously the market crashed and real estate value fell as low as 30, 40, 50%. And so HELOCs, being home equity loans, they use the home equity as a collateral. Well, the value of real estate isn't there anymore, right? There isn't equity anymore. And so banks started shutting down and freezing HELOCs so that borrowers can no longer make draws and borrow money from the HELOC, which again, all that was to stop or prevent borrowers from borrowing money against an asset that isn't worth the same amount anymore. But back in 2012, when Congress passed the Dodd-Frank Act and the lending practices and how banks were lending money got more stricter, right? They weren't doing no money down loans or no job, no income loans anymore. And so banks are gonna be more stringent and careful as to how they lend HELOCs in the first place. So if there is a swing in terms of the value of real estate, it won't necessarily put you, the borrower, in deep underwater situation. And with the Dodd-Frank Act came, regulations and new rules about, if the banks were to shut down or freeze your HELOC, they have to give you advance notice and sufficient reason as to why they're doing so. And if one bank is shutting down your HELOC or freezing your HELOC, it doesn't mean that you just go to another bank or another credit union and get a HELOC there. But also the strategy, right? The accelerated payoff strategy is about reducing debt, therefore becoming a less of a risk to the banks and lenders that are giving us the HELOC in the first place. Again, I've been teaching this concept for almost a decade, and I've yet to see a single client of mine lose their HELOC because their HELOC was shut down or frozen. Now, can it still happen? Yes, right? If you abandon your home or if your home becomes dilapidated, then yes, the banks have every right to shut down that HELOC or freeze it. If you turn your house into a meth lab or a drug lab, yeah, at that point, I think you have a little bit of a bigger problem than your HELOC getting shut down. So yes, can the bank still do it? Yes, but the probability is very, very low, especially if you're using it to pay down your debt, to lower the risk in terms of how much debt you have, how much leverage you have as the borrower. So it's very unlikely, but it can still happen for sure. So friends, I know that this is a strange or foreign concept to you. Maybe you're intrigued, you're interested, or perhaps you're concerned and you have some questions about this concept. But tens of thousands of homeowners here in the United States, like my clients, are using this concept to pay off their mortgage faster and therefore being able to catch up on their retirement. In places like Australia and New Zealand, it is said that about 1 in 4 homeowners are actually using a similar concept, of course, using the offset account, to pay off their mortgage faster and save money and time when it comes to paying down their mortgage. So once again, this strategy is called the accelerated payoff concept. And what I want to do is down below in the video description, I'm gonna leave a link where you can download a free calculator where you can punch in your numbers, right? Your mortgage information, your income, your expenses, and you'll be able to see a projected scenario of how much money and time you could potentially save using the accelerated payoff concept. So the calculator download link is in the video description down below, so definitely check it out. And I do have hundreds of other videos on this topic, and you may already have questions. So if you do, definitely go and check them out. And if you have questions right now, leave them down below in the comments. I do try my best to answer all the questions that I can. And in many cases, I use your questions and comments as inspiration for future videos that I make. And so what's really gonna help you right now is to just get familiar with it, learn as much as you can, do more research before you do anything, check out some other videos that I have. And you'll hear me preach this over and over again, and that is through education, through awareness, and through research, I believe that you'll make better decisions when it comes to your finances. And of course, that leads to helping you pay off your mortgage faster, helping you make better decisions when it comes to your investments, your retirement. And through those series of better decisions, you'll have financial peace of mind for your future. So that being said, definitely check out the calculator down below, along with other videos that we have in our channel on this topic. If you enjoyed this video, be sure to leave a like for the algorithm, and we'll see you in the next video.